Visionary Investor Podcast. I'm your host, Andrew Marks, and I'm a stock market wealth investment mentor, speaker, and entrepreneur who has a passion for all things stock market investing, diving deep into quantitative and qualitative analysis, creating formulas and calculations that optimize stock market investing, and creating a life that fits your biggest and wildest dreams. You're in the right place if you're ready to tap into some investing strategies that aren't taught without getting a degree, working for an investment firm, and some that aren't even taught anywhere else in the world. Find deeper clarity on your investments and what your future can hold. Strengthen your understanding of recessions, stocks, and your money, and learn the tools to accelerate your investments and wealth. You're here to be a visionary investor, not an average one. A passionate disruptor with uncommon goals in the investing world. It doesn't matter where you are in your investing journey. You're never too late to become a successful investor, and I'm here to help you do that. Let's get into the investing flow. That's why there's so many different companies out there, and a lot of their stocks don't actually perform well. They have not been good stocks that would have made you a good profit. So you want to take a look at the information I'm going to share so you can better understand, is this a good investment for you? And does this investment align with your goals? Can you understand why this company may be profitable in the future and lead to you making money through the profitable stock? Or on the downside, do you feel like this company actually is going to have trouble making money in the future, have trouble increasing their earnings per share? And this is going to lead to you investing into a stock. And not every company is going to be managed well so that it even gets there. It's very hard to manage any company. Imagine trying to manage a public company. There are a lot of decisions that need to be made, and there's so many different working pieces. I'm going to help you understand and uncover the different layers that are really important and essential for helping you find profitable stocks. The issue is, if you can't figure out what a profitable stock looks like, how are you going to know what to invest into? So I've broken down in this investor's handbook the essentials of finding profitable stocks. So there's two things you want to look at, and the reason why you want to find a profitable stock is because in the long term, this is what's going to actually rise the stock price. If you've listened to the previous episode that we shared on supply and demand, you'll know that companies that are more profitable, that are being managed better, and essentially are growing in a positive trend, will in the longer term be a more valuable stock. So you'll be able to make more money from this type of stock. So we're going to break down fundamental analysis, which is a great way that you can analyze a stock and figure out, is this a profitable stock or not? The two main things we're going to look at are both qualitative and quantitative factors. So qualitative, we're looking at softer data. So for instance, a competitor analysis. If we're looking at Microsoft, what would be Microsoft's competitors? Which companies directly compete? So if we're looking at potentially Microsoft Office, what companies would compete with Office? The next thing is management. And management is so important because when we get into the quantitative factors, you'll understand how a good management drives a company forward and how a bad management can completely destroy a company, which would then lead to a stock price plummeting. Then we have risks. So risks could include things like vendor supplier concentration. Imagine you have a company that's making chips, semiconductor chips, and they're 100% fully concentrated on getting the supplies that they need for those chips, maybe the pieces, copper, etc., from a specific supplier. Now, why this could be an issue is because what happens if that supplier goes out of business? Where are they going to source their products from? How are they going to get these raw materials? This could cause a major problem for a company, and not understanding the risks of that could lead to big issues. Another thing is country exposure. Let's say a company is getting a lot of its products from a specific country that then is banned. The US cannot trade with that country anymore. This is also going to cause a problem. Now, on top of that, there are industry-specific risks, and there's also macroeconomic risks. How sensitive is the company to interest rate changes and inflation? The next thing we want to look at is quantitative factors. We're going to start off with financial statements, which are formal records to report the overall financial health of a company. Why is this important? This allows you to better understand what's going on behind the scenes. So we're going to look through a few different financial statements that will better help you understand what's going on. The income statement shows how much revenue a company has earned, the cost of earning those revenues and operating the business, and what the bottom line or the net income was. So essentially, this is showing you how much the company earned after expenses were paid. Some key things to look at with this are, where was that revenue coming from? Was it all coming from the United States? Was it a breakdown of X% from the US and then X% from Europe? Or do we have multiple different regions that the company was bringing in its revenue from? This is also really, really important to understand how the company is making money, where they're making money from. The next thing you want to look at is revenue growth. Then you want to look at operating margin. So the company makes a certain amount of money after they pay their operating expenses. What's their margin? How much do they have left over? And how does that compare to the amount of money they were making? Then the net profit margin. So we're looking at the net profit and we're looking at the revenue. We're seeing how much is the company retaining? What is their income at the end of the day compared to how much they brought in? So these margins are going to look different for different industries, and it's important to be able to compare them so that you understand, all right, if a company has a 15% net profit margin and they're doing really well, another company may have a 30% or a 2% net profit margin and still be doing really well, because it could be specific to the type of industry. Some industries are way heavier on certain costs and others may be a lot lighter on costs. Then we're going to take this and we're going to look at the earnings per share, or EPS growth. What does this tell us? It's the earnings that you could expect to receive per share that you own. Now, we want to see that this is growing, especially over the long term, because that is an important concept used when we're valuing stocks. The next thing we're going to look at is the balance sheet. And this shows the assets, which are things that a company owns, liabilities, which are things that a company owes to others, and shareholders' equity, which is net worth or money that would be left over if a company sold all of its assets and paid off all of its liabilities. So you want to look at the following: current assets, things like cash; total assets, current liabilities; total liabilities, including things like long-term debt. Now, obviously, I'm giving you some specific things to look at. There's a lot more on a financial statement, but we really want to comb through certain pieces to better understand the overall picture. You can very easily get lost when you're analyzing a company. There's so much information, so we have to avoid certain noise. The next thing we have here is the cash flow statement. So the cash flow statement shows the movement of cash within a company. This is incredibly important, and it's very often overlooked when analyzing stocks. It uses information from the income statement and the balance sheet. So what's going on here? There are three different ways that a company's cash flow is affected: operations, financing, and investing. Let's talk a little bit about these. Net cash from operations. So think about cash flow from a company's main operations. This is the core of the company's business. So essentially, how much money, how much cash is the company bringing in from their core operations? So you're basically the company's basically taking their net income and making adjustments for cash changes to this number. An easy way to look at this is, if a company has accounts receivable, money to be paid by vendors or customers, think of when you invoice or bill someone for something, but then you don't receive the money for 30 or 60 days, for example. This is classified as income on an income statement, but the money has not actually been received yet. So the company would actually have an accounts receivable. They essentially would have less money on hand at the moment until the accounts were paid. Net cash used in financing. So cash flow from borrowing money or other financing. For instance, a company may repurchase common stock, and then there'd be less stock overall outstanding, which overall can increase a stock price. There's also payments for debt obligations. So if a company has borrowed $50 billion and $2 billion of that is due this year, they paid that. So you could see that they used that cash. They don't have that cash anymore. And then net cash used in investing. Investing into the company's business or other investments helps the company to grow in the future, and it may increase money available in the short term too. So different things that we could be talking about are property, plant, and equipment, acquisitions of other companies, and purchasing investments. Now, why is this important? This is showing, all right, what is the company actually doing to try to grow? Are they acquiring other companies that could help increase synergies and help them get to the essentially next level? Are they purchasing new properties? Are they investing essentially in the business by buying more equipment that can make them more efficient or can help them grow and take on more clients? Or depending on the line of business, it's different for everyone. If we look, for instance, at Apple's annual report, we'll notice that they've purchased recently a lot of marketable securities. So why is Apple doing this? Well, they believe that they'll be able to make a profit by by investing their money into this type of investment. Now, companies invest into other companies all the time also by purchasing shares of other companies' stocks, and they also purchase bonds. So the big thing here is this overall tells us what's going on, where cash has flowed into the company and where cash has left the company. And management can either do a great job managing a company's cash or do a terrible job. And, I've talked about it before, but if we look at, again, Silicon Valley in their investing section, they were purchasing investments that essentially were not able to be profitable investments. They were poor decisions. So how a company is managing this is very important. I mean, imagine if a company goes out and they purchase a $20 billion company and they think that that company is going to help them grow, and actually instead it really doesn't. And the company ends up being almost worthless, and it's not actually helping, it's making things worse. So that for the company, if it was a big investment, could really hinder the company's ability to move forward, and it could have really been a poor decision by management to invest into that company. So this is why essentially when we're looking through the different financial statements, decisions management teams are making are so incredibly important because they can literally cause the company's earnings to increase and their cash to be managed well, and they have liquidity, they have money to make smart decisions, or they need money. They're in this cycle of getting more and more debt. So the next thing we look at briefly is shareholders' equity statement. So when we're looking at this, we can see what common stock has been repurchased, we can see dividends, and we can see retained earnings. Essentially, how much money has the company retained, kept in after they've paid out, dividends and so forth. And this money could be used to help grow the company. And that's the thing at the end of the day, when we're looking at a change in cash, that's going to help a company because they have more money on hand to make investments if they have more cash. So based on this information, you would then look at different ratios, which we're going to discuss further in another episode. You're going to then take all of this information, you're going to use it to value a stock's price for the future using different valuation methods, such as price to earnings ratio, guideline public companies, or discounted cash flow. The essentials of finding a profitable stock truly lies in management and employees' ability to remain visionaries and look out for the company's best interest to help it grow. And while it seems obvious that every company would try to do that, not all companies are able to do it the same way. That's why there's so many different companies out there, and a lot of their stocks don't actually perform well. They have not been good stocks that would have made you a good profit. So you're not going to want to invest into this company. Thanks for listening, and don't forget to subscribe to the podcast, leave us a kind review, and follow us on all of their platforms at The Visionary Investor. Have a great day.